have been working in finance and accounting for the better part of the past 27 years, straight out of college pretty much. I have worked from the bottoms up. I started working in AP and worked my way all the way through to being an intern CFO and working as VP of Finance in different organizations. And that's afforded me the ability to understand the finance operation from the bottoms up. I understand all the processes going back to the transaction, and that's really benefited me in my career, and it benefits my clients in the information and the knowledge that I have to be able to support them. I usually explain this to folks that don't have a finance background, comparing it to a car, right? The health and the wellness of an organization can be compared to a car. Profitability statements are like the gas. This is how much income you have to be able to move your organization forward, right? With the equity statements tell you about the infrastructure of your car. Your tires good? Is your engine running at an optimal level? Do you need to change processes or do some kind of maintenance to be able to get you to the next level of your organization and your industry? Especially during growth cycles, right? Because your profitability statements will tell you how much you have to go on, right? Your equity statements will tell you about the infrastructure. What do you have? How much receivables you have? How much debt are you carrying? How much cash do you have to move forward? And these things in combination can be used to determine, where you want to see yourself and how do you get there? What tools do you have to put in place, or what tools do you need to upgrade to get you there? And do you need to introduce someone else? Like, do you need to go ahead and get some more capital to get you to that next level? Those are the types of pieces of information that you can get from looking at your financial statements. They allow you to see if there's a cash crunch. So when you start looking at trends on your cash, you can see that maybe there's points in time where cash is not great, where maybe you need to stabilize that. They allow you to see if your expenses are outweighing the revenue that you're bringing. Because really, when you're looking at a profitability statement, you're looking at the rate of return on your revenue, right? You could have sold tons, but if you're not keeping a good chunk of it, then you need to evaluate what the cost is and of that revenue, what the cost is of making that revenue. And maybe you make less, but you keep more of it by having less expenses. So those are the types of decisions that you can make by looking at accurate financials.